All right, so now Karen needs $2,500 a month. We just did a video where we took Social Security early. All right, so she needs $2,500 a month. She took Social Security at 62, which meant her Social Security benefit was $18,000 a year the first year because her primary insurance amount was $2,000 a month, which is what her benefit would have been at 66. But because it was reduced by 25%, and this was $1,500. But now we're going to say, what if she waits until she's 70 to take it? All right. So now Social Security, getting the delayed earnings credits are roughly 8% with a cost of living adjustment as well. And now she's going to be pulling money out of her IRA to make good while she's waiting for Social Security to kick in. And literally, I have no clue what this is going to look like. So it'll be interesting. When she took Social Security at 62, she was fine. No qualm there at all. Pretty decent net worth. I think it was $732,000 liquid net worth plus her home. So it's all good. In this case, well, let's jump into it and find out. So subscribe and smash, if you will. Everything else is still the same. Her net worth is still the same. So again, just to reiterate, her investment scenario is still the same. A moderately or aggressive account. She's an aggressive, which is 79, 80% stocks, 20% bonds, 7.1% is our expected returns going forward. Again, our inflation is being adjusted each and every year at 3%. And then the Social Security is being increased by 2.6. All right. So this is more on the conservative side. Now she's taking Social Security at 70, not 62. So let's see what we got. First and foremost, our likelihood of success when you run 1,000 scenarios in Monte Carlo. Wow, wow. I mean, that's a significant increase. Huh. That's a significant increase in the probability of success there. All right, that's nuts to me. All right, let's just see here real quick. Oops, not that. Let's just do as early as possible. I'm just curious. I can't remember. Was 83? Was that right? Yeah, 83. Huh. It's gonna be tough to beat, man. All right, so let's 80/70. From a tax perspective, from an income perspective, that's let's hit the confidence here. So here's a confidence. Oh yeah. Oh man, this is. I gotta tell you, my friends, it's gonna be tough. It's gonna be tough to not take Social Security later. We'll see. The median here is here's the dark blue vein. I see keep doing that, but if you see the dark blue vein, that's the median amount, the median, and here you can see it drops down to 70 from 334 all the way down to 208. Simply because she has no more. She's been pulling off her IRA. She's been pulling down her net worth. And then it spikes. It's going until here. It's 670, 697. I can't remember off the top of my head what it was last time, but I remember that this is significantly higher. And again, this is just her liquid net worth. This does not include her house. That's okay. Well, let's keep plugging along here. I don't know why I'm always surprised when I run these, and I'm always surprised how well it performs once Social Security is not taken until you're later. But all right, so here we have income. We have income inflows. Nothing. She got no money coming in. She has $30,000 of expenses. She's single, so her taxes are $3,025. Those taxes consist of how much the state, how much the Fed. Oops, and it's going to be distributions. I can't remember which one it is to see how much the taxes are. I know where it's at. Excuse me. If we go to taxes, tell you what, let's look at the tax. So she has $33,000 of IRA distributions. Remember, she needs $30,000 to live on, so she's got to take $33,025 to pay the taxes for the $30,000 she has to take out. So it's basically 10% tax bracket. $12,200 standard deduction because she's under the age of 65. And then we have $2,305 in Fed tax, and that's going to be another $1,000. California, that seems pretty high to me. Let's go to cash flows. 722 to California. All right. Well, I don't think so. I think that's high. Man, all right. Let's just keep plugging along here. The Fed's right. I just think California seems high to me, but okay. We'll go with it. All right. So $3,000 of taxes on a $30,000 expenses, which means you'll have to pull $33,000 out from her IRA. It's literally 10%. $34,000 the next year, $34,800 the next year, almost $36,000 the following year, $37,000, $38,000, $40,000, and then she won't have to put anything from her IRA, but she will have planned RMDs, required minimum distributions of $9,000. But now her Social Security will be almost $38,000 because she'll have the 2,000 PIA plus the delayed earnings credit. So 2,000 times 1.32, yep, 2640 times 12, plus the cost of living adjustments is, yeah, there you go, basically 38,000 of Social Security. And her expenses at this point are $37,000 because her expenses are $2,500 a month, adjusted each and every year for inflation at 3%. So here we have all this positive. She has more required distributions than she has income needs, and so that's going to be reinvested in her taxable aggressive account. I'll show you what I'm talking about. Link. I think we want to go to accounts. Yeah, go to withdrawals from accounts, and here's her IRAs. And here comes, as you can see, these are withdrawals from account. That's when she's pulling money from the IRA to live on. Here's required distributions, $9,000. And here's the additions to the account, which will be the RMDs that are left over going into the taxable account right there. All right. And then ending balance by account. So here the accounts are growing by the amount of RMDs, the taxable that she's not having to spend. She's not spending because she has more than enough Social Security to cover her expenditures. All right. So let's see. So she starts with 334 at the end of 2020. It's down to 325, 314, 302, 287, down to 230 at the end of 2026 when she starts taking Social Security. Then she doesn't need to pull money out or very little anymore, so it starts growing back up till the RMDs start to really be pretty problematic from a tax perspective. So here 305, and here's a taxable account. So if we can bring this over. There we go. And that is her total net worth. It's not really showing very well. Hold on a second. Okay. Not showing that well over here. All right, so let's see invested assets. There you go. So invested assets 891. Yep. Of which 843 is that doesn't break out the accounts. Let's go back. So the taxable accounts is 604 and the IRAs 287. So there's your 891. That's interesting. All right, so let me do a spreadsheet here. Actually, let's see. Here's the tax payments. I want to see a net worth too. And I'm going to spreadsheet these out. I'll share them with you. But net worth 1.403 million, of which 891 is in liquid accounts and 512 is in the home. All right, let me spreadsheet these real quick and I'll get back. Hold on just a sec. All right, so when we compare the two, when she took Social Security at 70 and then she took Social Security at 62, let's just go back and look. When she took Social Security at 62, her total taxes were $94,699. When she took Social Security at 70, her taxes were $78,093. So it's how much? I mean, what was the difference in there? $20,000 bucks. Almost $20,000 difference in tax. Crazy. All right, so now her net worth when she took Social Security at 70, the total net worth was $1.245 million, of which 732 was in liquid accounts. When she took Social Security at 70, her total net worth was $1.403 million, of which 897 was in liquid accounts. So her total net worth, it's 897, that's $160,000 more. On top of that, $604,000 of her net worth here will transfer to her heirs tax-free. And how much will be in the other account? 202, right? Because that's qualified again. Yeah, I'll do a wrap-up video on this, but man, that's nuts. All right, so that's Miss Karen she needs $30,000 a year to live on. I'm gonna do one more video where we're gonna delay. I'm gonna do another video where we're gonna take a reverse mortgage at 62 and Social Security at 62 and wait till we take her IRA until she's 70, all right, with our RMDs. If we can, I don't know. Reverse mortgage, we'll have to figure out the numbers. And then I'm going to do one where we take reverse mortgage at 62, and take it at 62, and then wait to take her Social Security till 70. So it's kind of like a bridge, if that makes sense. It'll be interesting to see how that shakes out. All right, so stick with me. Thanks now. Oh yeah, and just as always, don't forget to, did I say this already? Subscribe, share the video, say your piece in the comment section, and then smash the like button.